Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, March 18th, and what a difference a day makes. On Monday, the market was rattled by the news that Bear Stearns agreed to be acquired for $2 per share and the fear that other financial firms might face similar solvency issues that precipitated that fire sale. On Tuesday, those fears were cast aside following better than expected earnings reports from Goldman Sachs and Lehman Brothers that produced reassurances from both firms regarding their liquidity position. The ensuing response led to a massive rally in the financial sector, which gained 8.5% on the day, its largest gain since March 2000, and led all sectors in the broader market. The broad-based nature of Tuesday's rally led to gains for all 10 economic sectors, the lowest of which was a 1.8% jump in the defensive-oriented utility sector. That is respectable in its own right, but it qualified as an underperformance in Tuesday's market, where the S&P 500 advanced 4.2%, its biggest one-day percentage move since October 2002. Aside from the aforementioned earnings reports, the FOMC decision served as the other major trading catalyst. The committee ultimately approved a 75 basis point cut in both the Fed funds rate and the discount rate to 2.25% and 2.5% respectively. It should be noted, however, that the vote on the Fed funds rate carried dissents from Dallas Fed President Fisher and Philadelphia Fed President Plosser, who were in favor of less aggressive action. The major indices backpedaled some in the wake of the decision, as many participants were expecting a cut of 100 basis points. The disappointment soon faded, though, and stocks were quick to regain their winning form. Notably, the FOMC acknowledged that uncertainty about the inflation outlook has increased, yet it still holds the belief that inflation will moderate in coming quarters. In turn, it left the door open for more rate cuts, saying downside risks to growth remain and that it will act in a timely manner as needed to promote economic growth and price stability. The bulk of today's gains, however, were achieved ahead of the FOMC decision. To wit, the Dow was up approximately 300 points just minutes ahead of the FOMC decision at 2:15 p.m. Eastern Time. Joining the financial shares in a leadership position were the home building stocks. They got a lift from a better-than-expected housing starts report for February and a measure of hope that conditions may be starting to ripen for improved housing demand with the Fed's actions and reports that the regulator for Fannie Mae and Freddie Mac may soon ease its capital requirement for the government-sponsored enterprises in a bid to improve liquidity in the secondary mortgage market. The Producer Price Index was the other economic release today. It carried mixed news, with total PPI up 0.3% versus the consensus estimate of up 0.4%, and core PPI, which excludes food and energy, up 0.5% versus the market's expectation for a gain of just 0.2%. The market managed to look past the core PPI number, however, since it followed a tamer reading on core inflation in the Consumer Price Index. Separately, the equity market rally sucked some life out of the Treasury market as the 10-year note fell more than a point, driving its yield up to 3.46%. The commodity-driven CRB index jumped 1.9%, while the dollar index increased 0.2% in response to the smaller-than-expected interest rate cut. I'm Pat O'Hare for Briefing.com. Thanks for listening, and have a good evening.